All right, everybody. Welcome to episode number 6 of the Modcast. Remember, we call it a Modcast because it's not a podcast. Hey, your co-host, Gary Roth, Jason Gordo, we're coming at you, and we're going to talk today about the 10 reasons we said yes to a deal, a buyer's perspective, 10 reasons why we were excited about moving forward with an opportunity. Hey, and please, if you like what we have to say, please go on to your favorite podcast listening networks, like it, share it, tell your friends. We're on YouTube as well. You can watch the video version of this. And I always forget, Garrett, to mention, and you remember, how else could you find us?
You can find us on the web at Modcast.
Right.
I'll say it again, modcast.show.
Modcast.show. I always forget that piece. Gary remembers it. So I remembered to remember it this time, but I still didn't have the correct sequence of events there on the
No problem. We'll let you stay. We'll let you keep.
All right, cool. I've earned my seat. All right. So, Gary, you and I, we've been hanging out quite a bit. We've been talking to potential opportunities. We have great friends in the industry that have brought us a lot of opportunities. And this is going to be a fun episode. The 10 reasons we said yes. Now, we're going to do the reverse of this on a future one. I think it's actually episode number 7. The 10 reasons we said no from a buyer's perspective.
Yep.
And with all this activity in the marketplace right now, you would think that why would a buyer ever say no to a seller? Like, there's just so much volume. And you've been at this a long time. I've been at it a long time. It's pretty active. In the last episode, we talked about, there's more RIAs today than there were 10 years ago, even with all this M&A activity that's gone on and all this action in the marketplace. But what are your thoughts on kind of the volume of deals right now? And is it even possible that people say no to buyers or to sellers?
It feels like nobody says no, but undoubtedly, you don't see the behind the scenes of what's going on in other quote unquote buyers. Our friends at Alaris have a podcast called The Buyer's Boardroom, so it doesn't really happen in a boardroom necessarily, but the buyer's boardroom, if you will. But it definitely, maybe there are people who say no, but I think it would be interesting, and we don't have this information. The bankers out there would. Are there any completely failed transactions? In other words, are there any people who go to sell where there are 0 buyers? But there definitely seems to be at least one, if not a number of very interested parties for every house that goes up for sale in this neighborhood. So I think today we're going to talk a little bit about, from our perspective, the top 10 reasons that drive us getting to yes and being excited about an opportunity. Mm-hmm. Are these, let me ask you a question, Gordo, before we dive in. Are these in any particular order?
No, absolutely not.
Okay, great. So this is not in any order.
They all matter.
They all matter.
Yeah. So I would say there's no ranking. In other words, like if we give 10, they all are worth 10 points.
Right. And on that, when we get to the reasons to say no, I think there are obvious. We won't get into it now, but in a business that is all about, first of all, regulated industry, obviously highly trust oriented. There would be some very good reasons to say no if there's a problem on that front. Mm-hmm. But we'll talk about that.
Yeah, there's definitely third rail situations in the no's. Yeah.
Right.
Yeah.
All right. So
all right. So we're going to go back and forth a little bit here. I think this is one that is a must for all buyers, and I can get into lots of story about why, like examples and whatnot, but I think we'll hit some of these pretty quick. I think today's episode is going to be nice and tidy. But I think we all talk about cultural fit, right? I cannot tell you how many calls I've been on over the last few years where, our number one thing is cultural fit. And that includes me saying that all the time. Number one, cultural fit. But I was on with somebody who's looking to sell their business yesterday, and they had representation. And I asked them, what's the most important thing to you? And cultural fit was number one. So we all talk about cultural fit. How do you measure it? And how do you uncover it? And how do you make sure you have good cultural fit? You have any ideas on that?
Um, do you know that the Supreme Court once upon a time, many years ago, um, defined obscenity as something that you can't quite define, but you know it when you see it? So cultural fit may be a lot like that, where, I mean, there's ways to score it. In our past lives, we had scoring tools and people would grade it. And the reality is, though, it's still very subjective. Obviously, there are things that are objective, like how much AUM do you have? That's a number that you should be able to know. But cultural fit, because it's a two-way street too. But I think part of it is just sort of from our perspective or from a buyer's perspective, sort of knowing what are your sort of core values and maybe non-negotiables for people, and then applying that to what you're looking at. So if there's some things that might be um, really important when you're a acquirer that is looking for, say, growth oriented advisors, and that might be one specific thing. But if you have someone, well, no one will generally say, I refuse to grow. If you can look at a track record and see like, well, 10 years, there's been no growth and there's been no investment or effort to grow, then you might say, well, that's a bad cultural fit. So there's sort of a qualitative, quantitative piece to it. But I think the important thing is, from a buyer's perspective, sort of knowing what works and what doesn't work in the organization. One thing that is totally subjective, but has always been true, I think, across multiple businesses I've been involved in, I think you've been involved in, is something called the dinner test.
Yeah, I was just gonna say this. Yeah.
Do you want to tell everyone what the dinner test is?
Well, I mean, go for it. Yeah, go for it. But this is absolutely yes. This is it. This is it. This is cultural fit right here. Go
Okay.
for it.
Okay.
Yeah, you give it.
The dinner test is, if we're at a dinner, this person's part of the company.
Imagine
And
100 people in this room.
imagine 100 people in a
Yeah.
room. Is this someone who I would actively seek sitting next to? That would be a very positive cultural fit.
Yeah.
The negative would be, is this a person I would avoid sitting next to at dinner?
Right. Right.
And the
Right.
goal is to have a company full of people who I'm happy to sit next to anyone at dinner.
In
Happy to
this
sit next
firm,
to anyone.
absolutely every single person here today, perfect cultural fit. And I want them all at my table.
Right. Exactly.
Yeah.
So that's maybe the best test is the dinner test for cultural
Yeah.
fit.
And for the seller's perspective, when that dinner comes and there's 100 seats, are you thinking, you should think to yourself, do I want one as close to these people or as far away from these people as possible? Same test, right?
Yeah.
And so that's cultural fit. And like Gary said, there's some, it's a thought, it's a feeling, it's more emotion than a scoring that you can apply to it. All right, so that's one of 10, and we're going to hit these pretty quick. The second one that we talk a lot about in when we're evaluating an opportunity is business model fit. There's a ton of ways to be in this industry and do this business. I remember we were at Schwab Impact back in November in San Francisco, November 24, and I'm looking out at all the attendees. There's thousands of people there, right? And I thought to myself, wow, let's just say there's 5,000. I don't know what the number is, but let's say it's 5,000 people in the room. There literally could be 5,000 different business models in that room. I mean, that's what's so cool about being an RIA, right? You get to do the things you want to do the way you want to do them. You get to price them the way you want. You get to bring clients in that you want. You get to, move on from clients that don't fit your business anymore, your staff, how you deploy capital, all that stuff is a business model, right? And so, but let's talk about the big ones, RIA,
Yeah.
IBD, lift outs from wires.
Warehouse. Yeah.
That those are the big models, right? RIA, IBD, lift outs from wires. And so when we talk about business model fit, we really start with financial planning. That's the heartbeat of our relationship with the client, financial planning. Right. So if somebody shows, and then we move into a tax engagement where we're looking to minimize tax bombs that exist in this person's life in the future that maybe they're aware of, maybe they're unaware of. But how do we remove those to the best of our ability? How do we get advanced planning around tax solutions? And we'll actually do client tax returns as well. We'll do that work. And then we move to an investment management strategy, and we have a very, specific way that we talk about it. We have Tuck, who's amazing. He's an awesome investment management mind, really leads our organization around investment management. And then there's, estate and insurance and other planning engagements. But that's how we think about it. Planning, taxes, investments, risk, life, long-term care, disability insurance delivery, and then estate. And when we think business model fit, if we engage with somebody who says, and this happens, by the way, oh no, I'm a large cap or I'm a small cap growth manager. I tilt into mid cap growth and value when I think that that's a good place to be. So I have a little bit of sector rotation, and I'm globally diversified, and I have a couple of factor tilt. Like, you've lost us at that point. Like, that just, as Gary's falling asleep as I talk about this, that's how we think about these businesses, right? That's just not a good business model fit, right?
Yeah.
So we want people that, as I've described before, planning, investments, taxes, or they
Right.
want to deliver taxes. That makes for a good business model fit. So that's number 2. I'm going to let you hit number 3, because I think this one's this is a big one as well. I mean, they're all big, but this is a big one.
Yeah. Control sharing is number 3 on this list. Not number 3 in our hearts, but number 3 on this list.
Yep.
And that is, it's interesting in the dialogues that we have with folks and have had over many years, that some people, well, let's just put it this way. There needs to be an alignment between what the buyer thinks they're buying and what the seller thinks they're selling.
Yeah.
And if you need to understand as a seller, what is the day-to-day sort of operational and management sort of mindset of the firm you're joining. And from the buyer side, you need to understand, like, what is the mindset of the person who's joining you. And the truth is, I mean, we can't speak for anyone else's businesses. When you're building a national firm and you're buying individual advisory practices, the day-to-day, all the interactions that happen in those individual advisory offices are being managed by the people in those offices 100%. Like, there may be a centralized approach to portfolio building, there may be a centralized approach to planning, there may be, centralized compliance and HR and accounting and all those things, but the advisors are still meeting with the client support team is still talking to the clients. It's all happening there. So that, from our perspective, we wouldn't have someone join if we didn't trust that they were, top notch at that. And obviously, living up to the fiduciary standard in every way. But it is a shared control experience. You are no longer, running your own firm if you're the single owner or part owner all by yourself. You have partners. And so it's not complete control, but it is shared control, right? And that goes both ways.
Yeah, and the way we talk about it, the way just internally, the way we talk about it is a willingness to share control.
Right.
Right. Like, again, I can tell 1,000 stories on all of these, but we had a gentleman, I'm not going to give you the state, but let's just say in the southern part of the U.S., who, his brand was super important. The way he ran money was super important. His Excel spreadsheet financial planning system that he had built over his 30-year career was super important. And, like, everything was super important that remained.
Right.
And what he wasn't understanding is we as a buyer flood the seller's bank account with millions of dollars on the closing/join date, right? And for that, you're giving up control. not all control, but there needs to be a sharing of control, as you pointed out, right? You're still the North Star in the office. You're the managing director. You're motivating, encouraging, mentoring, guiding the team around you. You're still responsible for client engagement and client service, but you need to have a willingness to share control to be a great partner, right? And so that's something that we're looking at as we're contemplating bringing somebody in. All right, number 4 is things that I just kind of hit on: a brand, platform, operations acceptance. You kind of hit on some of these as well. We have a brand. We love our brand, Modern Wealth Management. We think we have a cool logo. We think it's on the absolute bleeding edge of what wealth management should be at all times. It will always be current because it's modern, right? And I know when I sold a business, we had a brand and a name, and we were out in the marketplace, my partner and I, and we'd spent a lot of money building brand awareness in our community. We were at all the charity events and nonprofit events. We sponsored everything. We were on lots of boards. We were in the Rotaries, and we did all the stuff to build a brand, right? It wasn't our name. It was our firm name. And nobody cares. Your clients do not care about that stuff. We changed the name to the firm that acquired us, where Gary and I met, and nobody asked a question. Their biggest question was, are you still going to be here? And am I still going to have a relationship with you and the team?
Yeah.
And who's really responsible for the decisions around my financial life and future? That's what the clients cared about. And we've seen this time and time again. So again, the reasons we said yes: people who were interested in adopting a brand. And what's been impressive here is every single person who's joined has desired to adopt the brand day one, right? It's awesome. Platform, the operating system, the technology that's running the underlying business, right? That platform adoption is super important. As you're considering who to join, you want to believe the platform that they built is exceptional and that you can plug right into it and use it, and then it will power your local office. And so we want somebody who wants to plug into our platform. And then operations acceptance, again, just kind of how we do things, the way we run the business. These are reasons we said yes. So I'll hit the top, the first 4, not the top 4. Cultural fit, business model fit, sharing or willingness to share control. And then the last one we just covered was brand, platform, and operations, right? Just kind of doing it the firm's way. All right, this next one, we could spend an entire, and we probably should, podcast on the next topic. This is critical as we look at potential business partners and what makes a great fit from our perspective. And that is equitize and incentivize the next generation in your firm. Man, again, we should probably unpack this in a full episode, but we're going to hit it really quick. Why is it important that the next generation is equitized or incentivized appropriately in a transaction?
Well, the business, for it to be a business, for there to be something enduring, it has to survive the founder or founders and whatever their involvement is going to be. And so presuming it's an office or a practice that's, if it's large enough today to have, a next generation, those folks are, you want them to be around, or you want the right people. If you haven't found the right people, you want the right people to have a reason to be, there for a very long time and forever, for their whole career, hopefully. And so you want to give them a piece of the the equity, because you want them to, feel like owners, and just like you do if you're the founder or co-founder. And so the people who have foresight tend to do this before, or at least at the time of the transaction. And sometimes it's just a conversation when something's being contemplated. But it's really important. And the reason why it's a cultural fit item is if the person or people who are the sellers are dependent upon a whole bunch of other people for the business to continue on beyond them, but they don't want to share anything with those people, that's a real red flag. It's not just a red flag about the continuity of the business in the future. It's a red flag about all the other things, the dinner test, everything else.
Right. Yeah, I love it when somebody says to us, look, this is Jim and this is Sally, and they're both super important to me. They've been with me for a decade or 2 decades. And man, my business it doesn't operate without Jim and Sally. And you need to incentivize them when they join your firm. Like, oh, wait a minute. Are they super important to you? Because you've not taken the proper planning steps to show them how important they are.
Yeah.
And look, they're going to know that you're getting well taken care of in this new partnership. So it is a red flag for us when you tell us how important and critical these people are to your success. And then we look at what they're getting paid and we look at what their incentive is to be there. And it's a mismatch of what you're trying to convince us of versus what you're actually doing for Jim and Sally, who are super important to you. So equitize and incentivize the next gen, or at least want to do that in the transaction, in the process of joining your partner firm. All right, so that's 5. Number 6, get rid of the stuff and focus on what you're good at. I can tell you, I spent 16 years in the advisory seat. I was an advisor for the first 16 years of my career in this industry. I did not get into the business to be the, CCO, to wear the compliance hat or the marketing hat or the investment hat. I never wanted to know what was actually in the client portfolio. I wanted really smart people with their fingers on the keyboards, allocating capital for clients, that was their absolute full-time, every day, all day long job. That it was the only thing they thought about when their feet hit the ground in the morning was how are we going to better invest client dollars, right? So I didn't even want to do that piece.
No, and you did a great job. I think all of your clients would have said that you had no idea what was in their portfolio.
Including my mother and myself. Yeah. I will tell you, the last decade I was an advisor, I couldn't tell you one investment we owned because it didn't matter. I knew that they were well cared for, but yes,
Yeah.
you're right. So compliance, marketing, technology, paying the bills, doing the accounting work, sourcing space to run the business out of, all the noise that's in your calendar. I didn't want any of that stuff. And I ended up at the end with all of that. And that's what absorbed my entire life and day.
Yeah, we always say, there's all these things that you have to do to be in business, but they aren't the reasons why you got into the business.
Right.
And, listen, some advisors and some firms, they reach the scale where the principals can, offload that, or they can expand their team enough to get rid of all those responsibilities. But most, I'd say probably 97% of the firms in the country are not big enough where the principals can do that and just focus on the things that they love and the reasons why they got into the advisory world to begin with. So, but if you're not willing to let go, and this, I mean,
Right.
a lot of these things tie together. If you're not willing to let go, then you're never going to really get the benefits of being a part of an organization that has infrastructure.
Yeah, you should be joining a partner where that partner is reducing the noise in your week, right? And all those things that we just talked about are noise in your calendar today. How do we create capacity so that you can meet with more prospective clients, solve complex financial problems for people, serve the heck out of them, and get back to the reason you got into the business in the first place, which was meet with people, solve problems, do good financial planning, allocate capital to great investors, and be a good communicator with clients on what you're doing and why, right? And so that's what we're looking to do, is strip all the noise out of your life that we can, so that we create that capacity in your calendar so you can grow. All right. So that's get rid of the stuff and focus on why you really got into the business. Location, location, location. I mean, I'm a real estate guy. I know what that means in real estate, but what is it? What are we talking about here?
Well, different people have different opinions about location. So, I don't have the view of, you have to be in, you know, one of the top 30 metropolitan areas or within X number of miles of this or that. To me, is it a location where we have the ability to grow the asset base? And that could be an underserved, much smaller population location, um, or it could be, a major suburb, or it could be a major city. And there are trade-offs to location because, major cities obviously have the most people, but they also have the most competition, right? They have the most
Yeah.
advisors
Right.
and, might not be the ideal places. So I think it's very specific. And a lot of times advisors have picked a location. Maybe it's because of it's close to where they want to live, or maybe it's because there was a sort of an affinity group, or sort of a defined group of people who they were sort of marketing to early on, who helped build their initial client base. So usually there's a good natural reason why a business is in a certain location, but it has to make sense. And from our standpoint, I think the most important thing is, regardless of the size of the market, that it be a place where there's obviously the opportunity to have sort of long-term, reasonable growth rates.
Yeah. And for me, I'd love an airport nearby.
Well, ideally, that's true, but it's not always true. We have some locations that are a little harder to get to, but have been proven to be great
But there's
locations
some of our
from
higher
a first
growers.
standpoint.
I mean,
Exactly. So,
yeah. To
so that's why I
to your
say,
point, they had capacity and they have a market that's
right,
underserved and they can go get it.
right. So it's no one thing, but um, it does matter.
It does. And those locations, again, back to the one before this, stripping the noise out of their calendars, what allowed them in those smaller locations to go out and be really the only advisor in town that was talking the way that we talk and doing the things that we do. So,
Right.
yeah. All right, number 8, so that was 7. Number 8, client segment, niche offering/market. I think client segment's an important one. We often, and we talk about this, there's investment bankers, there's brokers, there's M&A consultants, there's people out that are representing RIAs and IBD lift outs and wire lift outs who talk about, hey, you're going to love this team because they work with the ultra high net worth. Their target client's 25 million, or you're going to love this team because they have a niche offering. They go after airline pilots that specifically fly for American or Delta or United or Alaska Air. Or they have a particular market that is just amazing, right? A natural market that they're going after. So client segment matters. Like when we get those things called the SIM that we talked about in a prior episode, a confidential information memorandum, that's really the brochure of your business, and it says that your average client's $25 million. That's not a fit for us. That's not our client today. Who's
Right.
our client?
Our client is, the millionaire next door, or the person who could be the millionaire next door that's not quite a millionaire.
I like the other
And
way you say it, which is the single digit
yeah, I
millionaire.
was gonna get there. The single
Yeah.
digit millionaire. But the reality is it could be people with, it could be people with less than that, but who can benefit from our advice. It could be people with more,
Yeah.
but who aren't looking for maybe some of the things that people with 25, 50, $100 million are looking for. I think the important thing is know your market, know your client segment or your niche, and know where you compete, know where you can win, and play where
Yep.
you can win if you're an
Yep.
advisor. And if you're a buyer, if you're going to go out of sort of your own niche, you could try and be all things to all people, but most let's be honest, if we think about services or businesses or products that try to be all things to all people, they generally don't work that well. And so just understanding for us, it's like, is this a good fit? Do the tools we have, the solutions we have, do they fit with the kind of clients that this firm has, and vice versa?
Yeah, I like to say, look, if your client's a $5 million client, you do financial planning and investment management, it's $5 million bucks. And you know how to work with that $3 to $10 million client, but they average out at 5. And then all of a sudden somebody with $100 million comes your way. You get really bright-eyed and stars in
Right.
your eyes and excited. Well, that's like dumping a dump truck of raw materials in the middle of a factory floor that don't look like any of the other materials you're used to working with.
Right.
Now you've got to like reshift and retool, and you've got to do this. Takes all of your time and focus away. It's not that you can't work with those clients. It's just, who's your average typical client? We have lots of $50, $75 million clients in the firm, but the core client is the same kind of look and feel.
And I would encourage, firms out there that are maybe looking for a buyer partner. If I would encourage you to ask them, well, who's your target client? And if they say high net worth or ultra high net worth, I would say, and what does that mean to you?
Yeah.
Define
Right.
that.
Define it.
Because there's no hard and fast definition to that. And I would say that, but the numbers that I've seen people use have changed dramatically in the last 5 years, moving upstream. So I think 5-6 years ago, people would have said, someone with $5 million was high net worth. I hear some people now saying like, well, that's kind of the high end of mass affluent, and ultra high net worth is like 25 and up, and high net worth is like 10 to 25, and it's like these things are moving. There's no one definition. And so I would ask someone, if you're in that dialogue, tell me what you mean by that.
Yeah, that's a good point.
What dollar range are we talking about?
That's a good point. All right, we're going to hit the last two quick, not that they're not important, but we promised to land the plane early today.
Yep.
All right, client service model. And I really touched on this on number 2, business model fit, right? Client service model. Are you a planner? Are you all about a 15-factor large cap growth strategy? And every morning when you get up, your feet hit the ground and you're thinking Pepsi or Coke, UPS or FedEx as stock trades, that doesn't work. So really the client service model. Who's doing the service on the team? How are they doing this service? What's the cadence of service? All of that stuff really matters. If you say, oh no, we just mail them a report once a year, we don't really like to talk to our clients. Well, that's a no for us.
Right.
Absolutely a no. It should be a no for all buyers, but
there
for
can be
sure,
too little and too much.
There could be too little, too much.
I'll give one quick example. If you say you're a planning-led firm, but you hold a quarterly portfolio review meeting with your clients, then you're telling them, well, what's most important is our investment performance, and we're going to talk about it every quarter.
Right.
And so that invites, okay, well, you're really an investment manager. You're not really a planner. So of course the investment performance matters, but if you're having that meeting every quarter, it implies that you're really actively managing, and that's what you're doing, as opposed to, am I on track for my plan or not? So
that's where you're putting the focus, and where you focus is the message that you're delivering to the client is to who you are. You're not a financial planner. You're an allocator of capital. You're their stockbroker or their investment provider. All right. So it's client service model. We like kind of models that are like ours.
Yep.
The last one is really, it's one that we have taken full advantage of in the early days of the build out of modern wealth management, which is talent acquisition. We are, we have big goals and we have a lot to do around here. And when a firm comes and the advisor has built an amazing team around them, and we have hand raisers in those offices that say, I want to go do more. I think of lots of people in our organization that have joined Tuck on the investment team, or Jason Del Cole on the growth side, or Paul on the marketing organization, or, Nicole on integration and transition. All these people have been hand raisers saying, I want to have a career opportunity here and I want to do more. And we've said yes to firms that have great business models, a willingness to share control, and amazing people in the underlying business. It's been awesome.
Yeah, without a doubt. And I think that's, a lot of what other firms too look at, like, hey, how does this team add to the overall team, and can we add even additional service lines, et cetera. So it's these things all go hand in hand. And I would almost say, if you're a seller, you could use this checklist almost and in reverse. And say, am I getting all these things, or do these things all fit for me? So it's a two-way street, because it's a partnership. It's not an endpoint. And but these are some of the things we wanted to share. So
it's the conversations we're having on the back end. When we get off a call with somebody, or we've left a face-to-face meeting. But hey, I'm Gordo. That's Gary. This is the Modcast, episode number 6. Again, all your favorite listening platforms, go like it, share it, tell your friends. And go on to YouTube and like and share and comment on that as well. If you have questions, we'd love to answer them. And I think it's modcast.show.
You got it.
Is that it? Modcast.show. Go check. You can connect with us there.
Yeah.
All right.
Thanks, everyone.
Till next time. Bye-bye.